Goldman and Morgan Stanley are going down.
If we do not act boldly and immediately, we will replay the Depression of the 1930s, only this time it will be far, far worse.
You want too big to fail? Here it is.
We were within 24 hours of bank machines not working in 2008. In this reaction video, I'll break down and explain the financial concepts from the movie called Too Big to Fail, based on my work experience at Goldman Sachs and at the top hedge funds in the world. I'll also teach you many finance concepts from the movie, as I ran my own hedge fund in the fall of 2008 where I was massively short the market. And I'll explain what really happened in 2008. And along the way, I'm going to teach you many real finance topics that can help you when you invest. Now stick around, because at the end of this video, I'm going to grade the movie for Wall Street realism with a buy, hold, or sell rating. Lesson number 1 of 22. Never, ever, ever listen to the media when it comes to stocks. And I'll teach you how to pick stocks later on in this video. Case in point, in early 2008, the 5th largest investment bank, meaning Bear Stearns, went under. And here's what the media told you to do right before it happened.
Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear.
Always do your own investment research. Now, these people on television are superb at sales, and you will lose your shirt if you listen to them. Now, after Bear Stearns went bankrupt in 2008, the 4th largest investment bank, called Lehman Brothers, was next to fail. And here's the Lehman Brothers CEO, Dick Fuld, from the movie Too Big to Fail.
We're down 21%. On paper, I just lost $90 million. Personally.
Lehman CEO Dick Fuld then calls the government treasury sector head, named Hank Paulson, who used to be Goldman Sachs' CEO, and Lehman was his biggest competitor.
Tough morning.
We show top quality earnings. We beat every prediction. Yeah. It's the damn short sellers. You know the game, short and distort. They're rumor mongers, and they're making a killing.
Now, short selling means making money when a stock like Lehman Brothers here goes down. And Fuld is actually full of it, though, because the rumors were true in that Lehman was levered 40 times to 1, meaning for every $1 they had, they invested more than 40 bucks. So if the market moves just a little bit the wrong way, they go bankrupt. Lesson number 2. Please never use leverage when you invest, because this caused many hedge funds to go bankrupt in the fall of 2008. Lesson number 3. Only invest in very liquid stocks, meaning never own more than 10% of the average daily trading volume of a stock, as illiquid stocks own us in a down market, which also caused many hedge funds to go under in 2008. And Lehman Brothers used so much leverage that they actually ran out of cash.
What are your plans for a capital raise?
We're way ahead of you. Now, let me be clear. We don't need the cash. You know, it's about perception.
Buffett.
Now, we're going to come back to Warren Buffett in a second, but did you see how Hank Paulson rolled his eyes? It's because he hates Dick Fuld, and Paulson is portrayed as a hero in this movie, but he isn't really, because his animosity towards Fuld partially caused the chaos in 2008. I'll explain that in a little bit more detail soon. Now, Fuld was incredibly emotional about investing. Lesson number 4, always be unemotional when investing. Now, Lehman Brothers needs cash immediately, and Fuld reached out to Warren Buffett to invest, because at that point, the government was not going to bail out the 4th largest investment bank.
We're thinking of reaching out to Warren Buffett.
Great.
You and Buffett go back, right? Do me a favor and call him. Tell him Lehman is rock solid.
As Treasury Secretary, I can't advocate for a specific investment.
Animosity. So Buffett would make the investment of a lifetime later in 2008 in Goldman Sachs. But Buffett is patient, and he's going to pass on investing in Lehman. And so lesson number 5 is a Warren Buffett quote, which is be greedy when others are fearful, and fearful when others are greedy. Buffett also said the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. Also, lesson number 6. Lesson number 6 is day trading does not work. And if you disagree, then please tell me the names of successful day traders that have been very successful for many, many years. I want you to be long-term greedy like Warren Buffett, and you'll sleep better at night as well, that much I promise you. Now, not rescuing Lehman is a very tough call for Hank Paulson, especially because 2008 was an election year.
We just buried one investment bank. We've got another one that's barely breathing. This is a confidence game. People lose faith in Lehman. These banks are going to drop like dominoes, and I don't have the authority to do a thing about it.
Now, consumer confidence is crucial when investing because since 2/3 of the US economy is based on consumer spending. Now, when the American consumer sneezes, the rest of the world feels it. And so lesson number 7 is buy when consumer confidence, per the Vix, is terrible. Now, I put my reputation on the line on this one. When the Vix is above 70, like it was in late 2008 and in early 2020, buy no matter what, because nobody else will. Now, when the Vix is above 70, this means that there's massive volatility, meaning fear. And so be a contrarian and watch your net worth take off. Let's get back to the movie. The only way to save the economy was to ask Congress for a bailout, as Neil Kashkari, who reported Hank Paulson, mentions right here.
We're calling it the break the glass plan, what to ask Congress for if your back's against the wall.
Now, Kashkari got over $700 billion from Congress in 2008 in order to rescue the banks. If the banks die, so does the economy. Now, Congress was furious with Neil Kashkari, as here is what Congress said to him in real life.
Congressman, the Secretary is passionate about this as well. And permit me, please.
Passionate about what?
Helping homeowners, Congressman.
He is? Where? What country?
And arguably, Kashkari is the real hero, as he came up with the TARP bailout plan, which we will discuss very soon. And Congress absolutely crucified him for this.
You're on TV. You're the man. I don't know how much we're paying you, but you're our employee. Is Kashkari a chump?
Let's get back to Warren Buffett. He ended up talking to Hank Paulson and initially pushed back on investing to save the banks.
I understand you've been talking to Dick Fuld. We both know that investment banking is a profitable business.
I figure it made you a billionaire, so what?
I gotta believe that if the price was right, you wouldn't just walk away.
Now, there wasn't enough blood in the streets yet for Warren Buffett to start buying. So learn to say no more often, as Warren Buffett does, and be patient. And so lesson number 8 is tell yourself you can always buy that stock at a lower price. Again, do not listen to people on television to tell you what to buy. Now here's Jon Stewart coming after Cramer during that great financial crisis.
How the hell did we end up here, Mr. Cramer? I can't reconcile the brilliance and knowledge that you have of the intricacies of the market with the crazy bull I see you do every night.
Now, it gets much worse, though, because listening to the media costs retail investors a fortune. Don't trust them.
There's a market for it, and you give it to them, and I think
There's a market for and hookers. Well, you knew what the banks were doing, and yet we're touting it for months and months. The entire network was.
Lesson number 9, and this is really worth restating. Don't be short-term focused ever. And the only investment advice you should take is from yourself.
And so now to pretend that this was some sort of crazy once-in-a-lifetime tsunami that nobody could have seen coming is disingenuous at best and criminal at worst.
Now, the insane thing about 2008 was the banks blamed us, meaning retail investors, for this, as Dick Fuld says right here.
People act like we're dealers. Nobody put a to anybody's head and said, hey, Nimrod, buy a house you can't afford, and you know what? While you're at it, put a line of credit on that baby and buy yourself a boat.
The arrogance of Dick Fuld drives me crazy, and Wall Street too. And here we see his arrogance yet again.
You heard anything from Buffett?
He's asking for preferred shares at 40 with a dividend of 9%.
We were just at 66. What the
Now, maybe it's just an opening gambit, Dick.
Sounds more like a damn insult.
Now, preferred shares means shares that get preferential treatment. And so lesson number 10. If you're ever given the option to buy common shares or preferred shares, try if you can to buy preferred shares, as you get the dividend before common shareholders do. Now, if a company goes bankrupt, then the first in line to get their money back, meaning the investors with the senior claim, are the debt holders. Then the preferred shareholders, then the lowest of the low is the common shareholders. If you invest also in a private company, try to get preferred shares and not common shares. Lesson number 11. Don't ever buy a stock just because it has a high dividend yield. If the yield is, let's just say 20%, then investors are saying that this is not sustainable and the company might not be able to pay back the dividend. Do your own research to see if the dividend is legit, please.
I've seen this before. CEOs panic and they sell out cheap. Right now, the street's running around with its hair on fire, but the storm always passes. We stand strong, and on the other side, we'll eat Goldman's lunch.
Now, when I worked at Goldman Sachs, we were much better than Lehman was at stocks, meaning equities, but they were way better than Goldman Sachs at fixed income. Now, will Warren Buffett rescue Lehman?
So what do we do about Buffett?
Screw Warren Buffett.
The arrogance again. Now, the brilliance of Warren Buffett is that when he buys a stock like Coca-Cola here, which he bought around 1990 and still owns today, his brilliance is that after he buys a stock, he assumes that the market's going to be closed for 10 years and he cannot sell it. And so, lesson number 12, be an owner of stocks and not a renter, meaning not a tourist, and you'll make more money in the long run and you'll sleep better at night. Now, Warren Buffett taught one of my classes when I did my MBA at Columbia back in 1999. And I'll never forget when a classmate of mine pitched a tech stock to him. And Buffett said, I won't invest in that company because I don't know where that company will be from a product cycle perspective in 1 to 2 years. And what I want you to do is I want you to think of all the stocks that you've sold in the past because they went down. And you're kicking yourself now for trying to time the market. Please don't do that. Lesson number 13 is before you invest in a stock, ask yourself this very, very simple question. In 5 years, will this company and the sector it is in be more relevant or less relevant than it is today? And this will stop you from day trading. And this will stop you from getting seduced into buying stocks that are cheap for a reason. So how do you do investment research on companies? Well, give a person a fish they eat for a day, teach a person how to fish, and they'll eat for a lifetime. Whoa. Now, here's how I do investment research. I fill out this spreadsheet that I made, which has 100 steps. Now, we always start with assessing the management team. Then after we're done assessing the qualitative questions, we answer quantitative questions like the size of the total addressable market. Then what we do is we focus on building and forecasting our financial model so we can value the company with a target price in 5 years. And remember, we are long-term investors. Now, in this spreadsheet you see right here, you'll answer 700 questions, and then a one-pager will be created for you. And this is dummy data you see right here. And what's also created for you is a 100-page report that's created automatically. And you can use this to be a better long-term investor and bring these reports to your job interviews too. Now, please see the link in the description if you want to join my online programs where I provide you with mini templates like this one to help you get a job, invest better, and work smarter and not harder. Now, let's quickly chat about fiscal and monetary policy, meaning the two medicines that the government uses to fix the economy. So first of all, who are the two government doctors that can fix the economy?
He's got to raise cash.
I told him that. So we should buy up all the vacant houses and burn them.
Now, the government is out of options at this point. And so the government uses two medicine bags to fix the economy. Let's start with the Federal Reserve's medicine bag, meaning monetary policy, meaning the policy of money. How do they fix the economy? Well, what they do is in this medicine bag, they have this gun, okay? And what they can do is the Fed can actually cut interest rates by putting more money out there in the system. And the way they do this is by buying bonds from banks. So let's pretend I'm the Fed and I buy this bond from you, the banks. And the banks get cash that they're supposed to lend out to all of us. Now, the problem is, if they cut interest rates to close to zero, which they did in 2008 and also in 2020, then there's no medicine left in the Federal Reserve's blue medicine bag to fix the economy. Lesson number 14, cash is trash. And it's the absolute worst investment you could ever make. Why? Because the government keeps on printing this stuff. In fact, the government printed so much cash during the COVID crisis of 2020 that the amount of cash has increased by more than 40%. Now, when the supply of anything goes up, the price, meaning the value of money, goes down. So keep your cash in real estate, stocks for the long term, and other assets as well, like gold. Now, gold was my biggest long position in 2008, meaning ticker GLD. Separately, lesson 15, invest when supply is decreasing. For example, my grandfather, God bless him, I miss him, he used to say, Chrissy, buy land, they're not making it anymore. Lesson number 16 is risk management. In your stock portfolio, never have more than 5% in any one stock, and never have more than 20% in any one sector like tech stocks or healthcare stocks or retail stocks. Now, the Treasury Secretary run by Hank Paulson has another medicine bag to fix the economy. Let's see what's inside this thing to fix the economy. Aha, I see something here. The first thing I see here is a stimulus check right here. And this means the Treasury can give us money so we can spend more to help the economy. And these stimulus checks, the younger generation actually refers to them as the steal from us checks. There's nothing left in the bag now. How do they fix the economy? Oh, whoa. There's one more thing I see here. Okay, what is this here? Aha. Now, in the fall of 2008, the government created something called TARP, T-A-R-P, which stands for Troubled Asset Relief Program, that Kashkari, who's not a chump, helped to architect. And I'm going to come back to TARP in a minute. But first, let's get back to Lehman Brothers. Now, several firms offered to save them, but Dick Fuld remained arrogant as always.
You are not going to tell me how to run my company.
You don't stabilize the price, your traders are going to jump ship.
Selfish.
It's not just bankers and traders, Dick. Clients are pulling their money. There's going to be a run on this bank.
Now, a run on the bank means everybody wants to take their money out. And things got so crazy in 2008 that apparently some crooked hedge funds might have hired actors to line up at smaller banks in New York City to make it look like there was a run on the banks and those hedge funds profited by being short. And if the 2008 crisis happened today, it would be much, much more severe because everybody today uses mobile banking and they redeem without lining up at the bank, which is one reason why Silicon Valley Bank recently quickly went under. It's a self-fulfilling prophecy now with mobile banking. And the Dick Fuld arrogance gets even worse as he pisses off these amazing Korean investors.
I think you're making a big mistake here. There's great value in real estate assets.
We have looked at them.
Well, then you must have looked at them in the wrong way. So I just don't want to see you leave money on the table.
Lesson number 17, when selling, always bond before business. And when you disagree with somebody, use the feel, felt, found out methodology, which means instead of saying you're wrong, you say something like this. I used to feel this way, but I felt differently when I found out that. Now, what potentially really happened, though, was this, which the movie does not discuss. Hank Paulson called an emergency meeting with the heads of all the investment banks, including Dick Fuld from Lehman Brothers. And Paulson ordered Fuld in that meeting to take the rescue package from the Koreans. And Fuld was incredibly arrogant in that meeting with Paulson and all the heads of the other investment banks. And given Paulson's history with Fuld as his biggest competitor, Paulson literally dismissed Dick Fuld from the room, and the next day he let Lehman Brothers go belly up. Now, the carnage wasn't just Lehman Brothers, as this happened right here.
While the real estate market has put Lehman Brothers shares under pressure, mortgage giants Fannie Mae and Freddie Mac stocks are suddenly plummeting this morning after reports the companies may need to raise $75 billion just to remain solvent.
Now, Freddie Mac and Fannie Mae, they buy and guarantee mortgages from lenders, helping provide stability, liquidity, and affordability in the U.S. housing market. Now, in 2008, Freddie Mac and Fannie Mae faced collapse due to massive losses on risky mortgage-backed securities, which forced the United States government to place both companies under conservatorship to stabilize the housing market. And to make matters even worse, 2008 was the perfect storm as it was an election year.
If Fannie Mae and Freddie Mac collapsed, then probably the financial system would receive such a body blow that it could be disastrous.
Now, it's going to be tough to get Congress to agree to a bailout package, meaning TARP. And it looks like another bank is about to fail.
Okay, well, if you're going to Congress, why don't we deal with the banks too? Because Lehman is looking and Merrill's not far behind.
We'll be lucky to get them to move on Fannie and Freddie. We do what we can do.
Now, Merrill Lynch might go under. Yeesh. The perfect storm gets even worse at this point because of the 2008 Beijing Olympics. Why? Because leading up to the 2008 Beijing Olympics, Beijing spent so much money building up their infrastructure to show the whole world how awesome China is. And as a result, the price of oil hit $150 per barrel in 2008. And I remember a few years before 2008, I met with the CFO of United Technologies, the company that makes Otis elevators. And he told me that in the next 5 years, more buildings are going to get built in China than the cumulative total of all buildings ever built in every country since the beginning of time. And back then, every single year, China built the equivalent electricity grid infrastructure of the United Kingdom. This means insanely high commodity prices in 2008. Now, I want you to guess how many cities in China have more than 1 million people. No, it's higher. Guess again. No, even higher. It's over 160 cities with over 1 million people. Now, China buys a lot of debt, so naturally, they were very worried about the financial crisis in the United States in 2008.
Hank, I must ask you about Fannie and Freddie. We have hundreds of billions invested. You've assured us the investment is safe.
And it is.
We're watching a great deal of our money disappear.
Now, currently, the U.S. national debt is above $36 trillion, and Japan holds the most at more than $1 trillion, and the second is China with less than $800 billion. Now, they got together earlier this year, and they started selling their positions in order to drive up U.S. interest rates. And there's an inverse relationship between bond prices and yields. Why did they do this? They did this as a way to threaten Donald Trump to stop raising tariffs. And this is why Trump temporarily held off increasing tariffs earlier in the year. And this almost happened in 2008.
There was an approach last month from Russia. They have considerable holdings in Fannie and Freddie as well. They suggested we coordinate and without warning dump hundreds of billions of Fannie and Freddie's bonds onto the market.
So given globalization, economic warfare almost took place in 2008. And Hank Paulson was stuck. He had no idea what to do, as we see in this conversation between him and the Federal Reserve.
Was it a threat?
No, it's a friendly reminder. With a single phone call to Moscow, they can take down the entire U.S. economy.
Thank goodness that did not occur. Now, Paulson ended up temporarily rescuing the economy by doing this.
Sources telling CNBC that the government has just taken control of Fannie Mae and Freddie Mac.
This is awesome. Now, Paulson addressed the Fannie and Freddie issue. Now the market thinks that this signals that Paulson will rescue his former competitor Lehman Brothers. And recall that Paulson was the CEO of Goldman Sachs.
They just assume I'm gonna bail out Dick Fuld, like I'm the guy behind the elephant with the shovel.
They're all drawing a line from Bear and Fannie and Freddie right to Lehman.
There's no way the taxpayers are gonna go for another bailout.
Now, Main Street, understandably, does not want to rescue Wall Street. But just when you think things can't get any worse, this happens to AIG, which is terrifying.
Mr. Flowers, my people tell me you're the man to talk to. We've got a real problem here.
Yeah? What kind of problem?
It looks very much like we are about to run out of cash.
AIG?
So AIG was like a huge insurance company that promised to cover losses if banks lost money on risky loans. So if AIG failed, all those banks could have lost so much money all at the same time that the entire financial system could have collapsed. Now, Hank Paulson then got the CEOs of the top investment banks into a meeting, and he asked them to strategize on what to do if Lehman goes under. And here the CEO of Goldman Sachs, Lloyd Blankfein, he implies that if Lehman Brothers goes under, so what? And then we see Jamie Dimon's response from JP Morgan.
We've all seen this coming for miles. I don't think a Lehman bankruptcy takes down our firms.
You're asking us to save a competitor. Let's not act like you're doing us a favor.
Now, Paulson then correctly implies to them that, look, if we don't fix this, you might all go bankrupt because Lehman Brothers is a massive trading partner to all those banks in the room.
This is your problem. We can all argue about how we got here. Deregulation, derivatives, Dick Fuld made bad decisions. We're all responsible. It's a catastrophic mess.
And Merrill Lynch was about to go belly up. And the CEO of Merrill Lynch used to work for Hank Paulson at Goldman Sachs, and so the drama continues.
B of A is gonna buy Merrill.
They're going to put B of A together with Merrill. The federal government is snaking my deal. I cannot believe this.
Now, in that famous meeting of the top investment bank CEOs, they had a solution to fix the Lehman issue as the best bank CEO on the planet, Jamie Dimon, came up with this plan right here.
Hank thinks he can sell the good parts of Lehman to Barclays, but someone has to take the real estate crap that's weighing down the company. How many of you can kick in $1 billion to stop Lehman from going down? I'm in.
Goldman's in for $1 billion.
Thank God. So if Barclays, Goldman Sachs, and JP Morgan invest in Lehman, the US economy would avoid the next Great Depression. But the British regulators, where Barclays is headquarters, said this.
As Barclays regulator, we have serious concerns about this proposed arrangement. Even if we were comfortable with the agreement, which we are not, Barclays would need at least 30 days for shareholder approval.
Son of a bitch! So the problem was the financial markets could not wait 30 days, so the deal was off. And the insanity continues. So now the US government decides that Lehman has to go bankrupt.
The markets are in turmoil, as you know. A Lehman bankruptcy will help settle that uncertainty and we believe calm the market.
Are you directing us to put Lehman into bankruptcy?
And now the fifth largest investment bank, meaning Bear Stearns, and the fourth largest investment bank, meaning Lehman Brothers, are gone. Congress loved it, as Main Street does not want a bailout, especially in an election year. But Wall Street did not like this at all.
What? Dow's falling off a cliff. 400 points already. The credit markets are frozen.
Goldman and Morgan Stanley are getting slammed by withdrawals. Lehman thinks killing them.
So could the number one investment bank, meaning Goldman Sachs, and the number two investment bank, meaning Morgan Stanley, go bankrupt next? Absolutely. And Merrill was number three and basically went bankrupt because B of A, Bank of America, bought them. And we know that the fourth and fifth largest banks, meaning Lehman and Bear Stearns, already died. Now, you'll notice that Neel Kashkari, who's not a chump in my opinion, said the credit markets are frozen. Now, what does this mean? Well, when Lehman Brothers failed, banks panicked and stopped lending money to each other, causing the credit markets to freeze. And Neel Kashkari meant that businesses and banks couldn't borrow the money they needed to operate normally, putting the entire economy at risk. And this is why we were within 24 hours of bank machines not working in the fall of 2008. And things were so cray-cray that my mom called me and she said, "Sweetie, should we take our money out of Bank of America?" And when I went to work in the fall of 2008 in San Francisco, I noticed tons more cars were getting broken into. And I really believe that we were literally on the cusp of massive riots. And guns and safes were sold out across the United States. And stocks were crashing. And I told my analyst at the time to come up with long ideas. And he slammed his fist on the table and he said to me, "I don't want to buy anything." So we remained massively short the market. Now, imagine if you could not get a penny out of an ATM and all your life, health, and other insurance products were canceled.
Should talk to the president about how we'll contain the damage.
Before you speak to the president, we got another problem.
AIG.
Can this get any worse? Yes, it can, according to Goldman Sachs CEO Lloyd Blankfein.
Hey, Lloyd.
British bankruptcy administrator froze all of Lehman's customer accounts. You didn't square this with the British before you did it? People are freaking out.
Now, all Lehman Brothers assets were frozen, and a great friend of mine used Lehman Brothers as his prime broker for his hedge fund. And when Lehman Brothers went under, he couldn't sell his positions. So he and many other hedge funds were down double digits in September 2008, and this caused many hedge funds to panic sell their longs, even if their prime brokerage firm was Goldman Sachs or Morgan Stanley because of this.
They can't get their money. Not investors, clients. If customers think their money wasn't safe with Lehman, they're not going to trust us either. No one will do business with us.
Scary. And we face the real possibility of Armageddon, because the top two investment banks, meaning Goldman and Morgan Stanley, might go bankrupt. And everybody was exposed. And at that point, Warren Buffett said derivatives are financial weapons of mass destruction. And so lesson number 18 is try to please not use leverage when you invest in the markets. Now, countries might go bankrupt as well.
How could you let this happen with Lehman? What on earth were you thinking?
We did everything we could, Christine.
You allowed it to fail, Unc. It was a horrifying mistake. It is having catastrophic consequences all over Europe.
Now the title of the movie really makes sense. Now, I was short every bank I could get a borrow on back then. It was like shooting fish in a barrel. And Paulson has to do something fast, according to John Mack, who's the CEO of Morgan Stanley.
John, one.
The fallout from Lehman is killing us.
Short sellers are all over us. We're down 10% already. You guys have no idea what's going on out here.
And Paulson has to make TARP a reality. Okay, so what he did next was he tried a Hail Mary idea.
How are your earnings?
Strong. We're going to announce Friday.
Announce now.
Although Morgan Stanley's earnings were fine, it didn't matter. Investors lost all confidence in the markets, and the contagion virus spread to non-banks as well.
Got to know what's going on out here. We're having trouble funding our day-to-day operations.
Our finance division is infecting the rest of our business.
General Electric. This thing is spreading way past Wall Street.
Now, GE was hit hard because of their GE finance division, and GE was like a bank back then that could go bankrupt. And insurance giant AIG's exposure was to all major banks and non-banks as well.
Construction downtown, AIG. It's 81 million policies with a face value of 1.9 trillion. Billions of dollars in teachers' pensions. It's everywhere you want. Too big to fail. Here it is.
And teachers' life savings and pensions are now at risk. And the dilemma now is Paulson needs to get Congress to approve a bailout for the banks in an election year. And Congress will not approve it if it thinks Main Street doesn't understand how serious things are. Now, in this next unbelievable scene, the White House press secretary speaks with Treasury Department officials in order to decide how to spin, meaning sell, what is happening to the American people.
I'm going to have a press call first thing, and I really don't know what I'm going to tell them.
Tell them Lehman exacerbated AIG. The simultaneous payouts of CDOs and credit default swaps put catastrophic pressure.
Now, let me explain what this means. Okay. So, a collateralized debt obligation in 2008 was like bundling thousands of homes. This is where I wish I had three hands. Bundling thousands of risky homes into one investment that people bought thinking it was safe. Now, a credit default swap was an insurance policy that banks bought to protect themselves in case these bundled loans, CDOs, went bad. But when many did fail, the system nearly collapsed because too many banks owed each other money, tons of money at the same time. Now, this movie, Too Big to Fail, it's part of a trilogy, okay? And there are separate movies that weren't made by the same company, but it's a great trilogy of what really happened during the financial crisis of 2008. So Too Big to Fail is the 2008 crisis from the government perspective. The movie Margin Call is the 2008 crisis from the perspective of investment bank Lehman Brothers. And The Big Short, this is great, The Big Short is from the perspective of hedge funds. Now, please see the links in the description of this video to watch my video reviews of The Big Short and Margin Call, as well as the movie Wall Street, Wolf of Wall Street, and dozens of other videos on the TV show Billions. Let's get back to credit default swaps, which AIG provided as an insurance policy.
AIG figured the housing market would just keep going up, but then the unexpected happens.
Housing prices go down.
Poor bastard who bought his dream house. The teaser rate on his mortgage runs out. His payments go up. He defaults.
Now, Main Street now loses, and Wall Street wins, as Wall Street banks get bailed out, and it's completely unfair. Now, they really should be on the hook to pay back those that lost their houses in 2008. Now, what happens if AIG cannot pay the insurance on these crappy assets?
AIG can't pay. AIG goes under. Every bank they insure books massive losses on the same day, and then they all go under.
And what do I say when they ask me why it wasn't regulated?
No one wanted it. We were making too much money.
Now, desperate times call for desperate measures. And this is where Ben Bernanke comes in. And we're very lucky that Bernanke did his PhD at Princeton in Depressionary economics.
We've been putting off going to Congress.
It's 2 months before an election. They can't vote yes to a massive bailout of the entire banking system. Never get reelected.
The United States was at an economic and financial war, and presidential nominee, patriot, and war hero John McCain put his campaign on hold to try to fix this, God bless him. And Democrats and Republicans are really upset at any sort of bank rescue at that point.
You can't just hand the banks massive piles of cash. Nobody's going to go for it. To the Republicans, it's nationalization. To the Democrats, it's a bailout.
Now, if the government were to bail out the banks, how much would it cost? Neil Kashkari, who's not a chump, explains this.
There's $11 trillion in residential mortgages. There's $3 trillion in commercial mortgages. That's $14 trillion. You got to figure about 5% default rate. 5%, $14 trillion is $700 billion.
Now they have to scare the crap out of Congress. So Congress approves this TARP thing here. So let's come back to TARP now.
Troubled Asset Relief Program?
TARP, we're calling it.
How is it possible you didn't see this coming?
Now, after that scene, I know for a fact that more than a few people are going to make a comment about, I don't know, insider trading maybe. But in all seriousness, for a change, there's no way that Paulson can get Congress to approve a massive bailout without support of Nancy Pelosi, and we're going to come back to Nancy Pelosi very soon. Now, the unsung hero of this story is Ben Bernanke, who did a superb job convincing Congress.
The Depression may have started because of a stock market crash, but what hit the general economy was a disruption of credit.
Now, if consumers can't get access to money, meaning credit, then we would enter another Great Depression. And without access to money from the banks, democracy actually ends.
If we do not act boldly and immediately, we will replay the Depression of the 1930s, only this time it will be far, far worse.
Separately, Tim Geithner, who worked for Hank Paulson, told John Mack, the CEO of Morgan Stanley, on a phone call to sell his company to JP Morgan, and here's John Mack's response.
Cover your ears. You tell Tim Geithner to me. I'm trying to save my company.
That's not accurate. I know John Mack, and he told me that he actually told Tim Geithner on the phone to, and he did this while he was on the phone in his New York City apartment. Now, I did a few venture capital deals with John Mack, and I've met him a bunch of times, solid guy. And he gave me, there's a point to this guy. He gave me this book here, as I'm part Lebanese, along with a really, really nice note as well. And the best way to network is to find something in common with somebody, which is how I got my first meeting with John Mack at his office in New York City. And my success rate, humbly, in getting meetings with people I've never met before using my networking methodology on LinkedIn is very, very high. And in my firm, if you're a client, we not only make your entire LinkedIn profile from scratch, but we teach you how to get many meetings. Please see the link in the description of this video to set up a call with us. And whenever you see a job opening online, you literally have a 1 in 250 chance of getting the job. Those who get the job often know someone in the company. And so lesson number 19, remember that your network is your net worth, and relationships are often far more important than product knowledge. Find something in common with people as a way to connect and bond. Now, John Mack is brilliant, and he made a deal with Mitsubishi to rescue Morgan Stanley. Then the CEO of Goldman Sachs had this reaction right here.
Morgan just made a deal with Mitsubishi.
So we're the only bank with our dick still in the wind.
I'm calling Buffett again.
Now, Buffett is very successful because of lesson number 20, which is he learned to say no more often than yes. That's worth repeating. He's also successful because of lesson number 21, which is he mastered the art of public speaking. In fact, on his wall, he has his certificate of completion from his Dale Carnegie public speaking class and not his Columbia master's degree. And like Warren Buffett, I took the Dale Carnegie public speaking class when I was 19. And that's the only thing we have in common. And my son here, Matthew, who just turned 19, I just signed him up for the program as well. Now, have you ever seen an interview with Warren Buffett and then you have a reaction of, oh my gosh, I'm so confused, what did he just say? Never. And so lesson number 22 is always write and speak at a 10th grade level. And I know that sounds messed up, but I have my own column in Forbes magazine and my editors always tell me that. Your ability to explain complex stuff in really simple terms can make you a fortune. And so please use ChatGPT for help. Let's get back to Warren Buffett though. Here's what the Goldman CEO and Buffett spoke about on that call.
Warren, thanks for calling back. How are you?
Just fine, Lloyd. What can I do for you today?
I'd like to talk to you about taking a stake in Goldman Sachs.
What do you have in mind? Sounds expensive.
Maybe not.
I love the casting in this movie. Let's now get back to Nancy Pelosi. So Pelosi, we know, is a Democrat. And Paulson was appointed by Republican George Bush Jr. So Paulson had to literally beg Pelosi to agree to the bailout.
Nancy?
Oh, gee, Hank, I didn't know you were Catholic.
We need to get together on this.
We're not the ones trying to blow it up.
I just ask you to stay with us.
So Paulson's Hail Mary prayer on his knees actually worked. And thank goodness the government caved in and agreed to bail out the economy, meaning using TARP. I shouldn't say the economy, I should say the banks.
The motion is adopted.
After rejecting the Bush administration's TARP plan only 4 days ago, the House passed it today. The big question now, whether investors will take comfort in the news.
Now, desperate times again calls for desperate measures. So now the government has a bazooka filled with $700 billion to save the banks, as well as AIG, Fannie, Freddie, GE, and other companies, and the economy too, I guess. But will the investment banks even accept the money? They don't want the government to tell them what to do. I mean, this is a democracy. So the next step is Paulson meets with the heads of the investment banks and has to convince them to take the money as part of TARP.
Treasury will purchase preferred stock in each of the banks represented in this room. That stock will yield 5%. We give you money, you lend it out. All 9 of you will participate in the program.
Now, here is the amount that the government wants each bank to take as part of TARP. And John Thane, who is the CEO of Merrill Lynch and used to work for Paulson at Goldman Sachs, really shows how selfish the banks were when it came to this proposal.
What kind of protections can you offer on changes for compensation policy? I mean, if the government is going to become a part owner, does that mean that the government is going to dictate compensation?
You're asking me about your bonus right now, John?
So what's BS about this is that by 2010, the banks who were rescued by US taxpayers paid themselves record bonuses while millions of Americans lost their houses and everything. Now it makes sense why we had this massive Occupy Wall Street movement after 2008. Ben Bernanke then gave these investment wankers a sober wake-up call.
The country is facing the worst economy since the Great Depression. If the financial system collapses, it will take every one of you down.
Yeah, and Bernanke is the real hero here. Now, realizing the chaos that would occur if the CEOs did not take the money, John Mack, who's a stud, is the first to sign, and then the rest followed.
Give me the papers.
You can't just sign it.
Oh, no?
Not without your board.
My board's on 24-hour notice. I think they'll go along with it.
Now, what actually happened was the banks selfishly did not lend the money out until the government really pressured them. And I remember in 2008, I literally had to get down on my knees and beg my mortgage broker to let me refinance. It was ridiculous. Now, one fascinating thing that they left out of the movie was the fact that in September of 2008, the government made it against the law for hedge funds to short hundreds and hundreds of companies like banks and companies like GE. And this led to a massive rally one day. I remember that in September. And my team and I decided to not cover a single share because then we would be net long and we couldn't short bank shares. So we made the very difficult decision to stay massively short the markets in the fall of 2008. Although my hedge fund humbly did well that fall in 2008, it was depressing. It was depressing coming to work every day and hoping that bad things would happen to companies. And so what I did was I transitioned my fund and started investing in private companies like Facebook pre-IPO because I think that being a long-term investor is prudent. I switched to venture capital. Now, in the aftermath of the 2008 crisis, most of the banks that received TARP bailout money actually repaid the US government between 2009 and 2012, with major banks like JP Morgan, Goldman Sachs, Morgan Stanley, and B of A repaying mostly by the end of 2009. And then by 2014, the government had recovered most of the funds it lent to the banks, which ultimately earned a profit from these repayments and dividends. Let's talk about grading the movie for Wall Street realism with a buy, hold, or sell rating. Too Big to Fail was based on Andrew Ross Sorkin's brilliant book, and it's an incredible inside view of the 2008 great financial crisis from the perspective of the government. And without this movie, Sorkin might not have cast Paul Giamatti in Billions. And the movie did a great job of showing how close we came to another Great Depression. And I do think that Bernanke and Neil Kashkari were the true heroes, though, and a little bit less so Hank Paulson. The movie really should have focused more time on how Main Street got screwed in the long run. And I think that the government should create a $1 trillion fund that the banks that got rescued must contribute to over 20 years. And the proceeds should go to those that lost their houses. Now, the movie also did an awesome job of showing us how the government's hands were actually tied and the perfect storm that emerged in the fall of 2008. Not only due to the great financial crisis, but also due to the pressure from Beijing and the fact that it was an election year. And Sorkin is a genius. And without this incredible movie, we might not have my favorite TV show ever, which is Billions. The acting was impeccable, and it's the only movie that credibly shows what happened behind closed doors in the crisis of 2008, according to the government. As a result, I'm going to give this movie a buy rating. Please like, comment, and subscribe, and I'll see you in my next reaction video when I react to finance topics from the movie Wall Street Money Never Sleeps. Thank you.